I'd like to thank everyone for listening in on this presentation. This is a rebroadcast, a repeat of a presentation that was originally given on Tuesday, October 3rd at 7 p.m. to the clients of Affiance Financial. The purpose of this presentation is education only. None of this information should be construed as tax advice. The idea is that hopefully it gives you some information and some ideas that you can discuss your personal situation with your accountant, attorney, or financial advisor who knows your specific circumstances. What we're going to talk about in this presentation is first some tax concepts. Make sure we're all on the same page in terms of the information that we use. I've been doing taxes for over 25 years, and so a lot of the terms that I use is second nature to me, but maybe new to you. So we want to make sure that everyone's on the same page so we can talk about what is a deduction, what is an exemption, what is a credit, and we can know what those things mean. We're also going to talk about changes in the Minnesota tax legislation that happened over the summer, any changes in federal tax legislation that happened in 2017, and various tax strategies that are available in 2017 through the rest of the year. So to start, we want to do just a brief breakdown of how our tax returns work and make sure that we're using the same information. And the tax system, believe it or not, is a relatively simple and elegant system in terms of what has been created, and it's fairly easy to follow and follows very closely to the 1040, the first 2 pages of your tax return, and we'll go through that. Obviously, what happens is that things get much more complex for a whole variety of reasons and situational complexity, etc. So we start with gross income. That's the first part of your tax return in terms of the numbers section. And gross income is either earned income that you have worked and you've received a W-2. It could include dividends or interest, withdrawals from retirement accounts such as an IRA or a 401k, as well as self-employment income or the sales of an asset. Anything that where you sold an asset and there was a gain associated with that sale would also be considered gross income. Some of the information, the IRS validates that gross income against either a W-2 that you would receive or a 1099. Reducing gross income is what is called adjustments to income. And again, that's actually on the first page of the 1040. And examples of adjustments to income would include self-employment tax, alimony, contributions to an individual retirement account, an IRA. Those are kind of the most common examples of adjustments to income. The net of the two is what's called adjusted gross income. So when you hear in the media or newspapers when they talk about adjusted gross income, that's the number they're talking about. It's a specific calculation of gross income minus adjustments to income, and that is on the bottom of the 1040. It's the last line on the 1040. That line gets brought up to the second page of the 1040, and from that, you first deduct the greater of standard deductions or itemized deductions. The standard deduction is a set number based upon the type of household or the filing, whether it's single or a family. Itemized deductions is what's done on, ultimately ends up on Schedule A of your tax return. And that would include, the most common ones are medical expenses, state taxes paid, mortgage interest, and charitable contributions. And there are others, I mean, there are other itemized deductions, but those are really kind of the most common or the most material of the itemized deductions. You take the greater of the two of either the standard deduction or the itemized deduction, and that is a reduction to adjusted gross income. And the other thing is personal exemptions. And the personal exemptions is also a deduction to adjusted gross income. And the personal exemptions is made up of the number of people in the household and dependents in that household. So the number of people you support, that could include children, it could include a parent or senior who is living in your house and that you are supporting. The net of that calculation, again, adjusted gross income, less either the standard deduction or itemized deduction, less personal exemptions, equals taxable income. That amount is calculated to figure out your tax. Now, we are on a graduated tax system, the U.S. tax system, which means that basically the taxable income is broken up into different brackets, and each piece is taxed at a different rate. So it starts at 10%, then 15%, and moves upward, etc. It is not like your tax rate is 33% and all of your taxable income is taxed at 33%. It doesn't work that way. It would be certain amounts would be taxed at the lower tax rates, and then the marginal amount is taxed at the highest tax rate. The marginal income above that certain level. And we'll get to that in a little bit. But that's how the tax is calculated. And by the way, that's right. When you hear in the media talking about flat tax, what they're talking about is one tax rate being charged for all income as opposed to the graduated rate. Then the reason they have that graduated rate is for lower income individuals to get a more favorable tax. From that tax, we're not done yet. There is a reduction based on credits. And so credits there's a variety of different types of credits. There's earned income credits, again, based upon income level. There is education credits, but a variety of different credits, and that reduces your tax. And that becomes now your income tax liability. So the income tax liability is what you owe. The one thing that I think is really important is tax credits are worth more than tax deductions, than itemized deductions. Tax credits, because tax credits are a reduction of your tax, whereas itemized deductions are a reduction of income used to calculate tax. So let's say you were at the 25% marginal tax bracket, right? One tax credit is equivalent to $1 of tax credits is equivalent to $4 of deductions. So that's how, again, the basic tax system works. So where does it get more complex? It gets more complex really quickly. And that is because, number one, we have 7 tax brackets. In the first of the blue columns, the ordinary income is being taxed at different marginal tax rates depending upon where you fall. So that becomes complexity number one, again, starting at 10% and going all the way to 39.6%. The other thing is that different types of income are taxed at different. So long-term gains and dividends, depending upon what bracket you are in, get taxed at a different rate, either 15% or 20%. I'm going to skip the green for this presentation, although again that information is in there, and just go to the purple for a quick second, the purple columns. And so the net investment income tax, that's what is commonly known as the Obamacare tax. And again, that is tax on investment income of 3.8% based upon certain income thresholds. And the other thing is that we also have what are called reductions in deductions or a phase out of deductions. And that's what's called the PEP and PEAS deductions. So basically what Congress wanted to do is they wanted to increase the tax revenue, but they didn't want to increase taxes. They didn't want to say that they were increasing taxes. So how did Congress do it? They did this by reducing deductions based upon income levels. And finally, we have the AMT, or alternative minimum tax. The alternative minimum tax is a totally separate calculation of your income tax, and you basically need to calculate your tax under the traditional method and under the alternative minimum tax method. The greater of the two, the greater tax liability of the two is the one that you pay. So effectively, the alternative minimum tax is based upon phase outs of deductions and exemptions. So we've covered what's the difference between a tax credit, tax deduction, what's a itemized deduction versus an exemption. We talked about capital gains losses a little bit. We talked about AMT, the alternative minimum tax. And we talked about who's paying. And so I thought this was really interesting. This is from a column by James B. Stewart in the New York Times, who talked about who pays income taxes. And again, this is just pretty interesting. And that is the top 1%, which is about 1.4 million taxpayers, and who have income as of greater than $466,000. And this is data from 2014. They paid about $542.6 billion in federal tax, or 39.5% of total income tax. If you look at the top 10%, including the 1%, The top 10% are those who have income greater than $133,000, and they pay 71% of total tax. And what is the top tax rate paid by the 1%? The top tax rate paid, the average rate for the 1% is 27% of adjusted gross income. The top 10%, the average tax rate is 21% of gross income. So you have to say, well, okay, how is that possible? We just saw the tax brackets on the prior page, and the top tax bracket is 39.6%. How is it that the average tax rate for the top 1% is 27%? And the reason is because of the type of where are they earning income, that a significant portion of their income may not necessarily be earned income. It could be through capital gains and losses, interest, dividends, and particularly interest through municipal bonds, which are tax-free for federal and could be for state as well. So let's turn to Minnesota tax legislation and the changes that happened in 2017. And this is actually probably the most significant tax legislation in Minnesota, probably since 2014. We had about $650 million in tax cuts. So how did we get here? What happened? Just kind of a brief background. We may remember back in 2009, the budget situation in Minnesota was not good. We were running deficits. We had to borrow from the school system. Again, multifactorial problems, including the financial crisis. New administration comes in, tax rates increase, economy gets better, and we find ourselves with budget surpluses, which is a good thing. The new tax legislation is basically redistributing that tax receipts, which will reduce the surpluses and will help different groups of people. So who does it help? Anyone have a guess in terms of which one wins the most and who wins out of this entire list? Well, as a matter of fact, everybody is a winner, and the greatest winner is actually seniors receiving Social Security. But everyone here is actually wins a reduction in tax rates for 2017. And we're only going to focus for purposes of this session on those tax changes affecting individuals and not on corporations or states, etc. So as I said, the biggest winner is seniors receiving Social Security. It's anticipated that about 284,000 senior citizen tax returns will receive deductions, $3,500 single, $4,500 for joint, and 72,000 of those will no longer pay state income tax. By the way, keep in mind that there is a formula for calculating that deduction, and it is income dependent. And so the vast majority, I shouldn't say the vast majority, but people listening to this may not actually receive a deduction on their Social Security. The second change that was made, and again, this is more a list of changes and not necessarily in any particular order, is people saving for college. So previously there was a credit, so that has been in place of contributions up to $500 tax credit, but there was a phase out for those credits. You also had to contribute to Minnesota 529 plan. They now have a deduction for contributing to a 529 plan, $1,500 deduction for single, $3,000 for married of contributions, and there is no income limit on this deduction, and the contributions can be made to any state 529 plan. It does not necessarily need to be Minnesota. So that's a new thing, new benefit to college savers, and it can be parents contributing to a 529, it can be grandparents contributing to a 529. Doesn't make a difference. Also, students or graduates who have student loan debt will be receiving a deduction or a credit, excuse me. They'll be receiving a credit for their student loan payments. And the student loan payments, that credit is for either interest or principal. And it also is for student loan debt forgiveness based upon very specific debt forgiveness programs. Teachers also receive a tax credit if you are a K through 12 teacher who's completing a master's degree based upon your core job, the material you are currently teaching, so directly related to your field. You can receive up to $2,500. That credit is offset by any money that a teacher would be receiving either from their educational institution, from their employer, or from scholarship. Another new credit is based upon dependent care. And again, it's based upon income levels as well as number of dependents that you have. But again, so you can see that the focus has been on lower income seniors, students, families, saving for college. That was a lot of the focus of the tax law changes in the 2017 Minnesota Omnibus Budget Act. Farmers also got some tax relief for property tax that they pay, because they tend to pay a disproportionate share of school district services. So they received a tax benefit as well. The other big change was the estate tax exclusion. So the cap on the estate tax exclusion went from $2 million to $3 million. That cap is going to be phased in over a number of years. Starting this year in 2017, it went up to $2.1 million and will be progressively going up until 2020. In 2020, the estate tax exclusion will be $3 million. And again, this is Minnesota state estate tax we're talking about. Minnesota does not allow for portability, unlike the federal, and so you have to keep that in mind. What it means is that for a couple that has $6 million, with proper estate planning and proper estate and tax planning, they do not need to pay a Minnesota state estate tax. Now, if they do not plan properly, and again, we're talking about they don't need to pay state estate tax of $6 million in 2020. Today they would, because again, it's at $2.1 million. But looking out, that is the direction of where they're going. By the way, this is not to be political, just again, to put color in, this was something that Governor Dayton actually wrote a letter about disagreeing with Congress passing this specific item in the Omnibus Budget Act. But that's where we are. But let's say we have a couple, Harvey and Irma. And again, I don't know if you read in the newspaper, there actually was a couple that was named Harvey and Irma. But so you have Harvey and Irma, and we're talking about, and it's the year 2020, and they have $5 million assets. And Harvey dies. And Irma disclaims $3 million, the maximum she could disclaim in 2020, and that moves into a trust for the benefit of Irma that she can use for expenses as she needs. And her estate is $2 million. On the death of Harvey, no Minnesota state estate tax is due because $3 million is the exemption. The rest flows to his wife, to his spouse. Okay, Irma dies the next day. Very next day, Irma dies after all the tax work has been completed in terms of the exemption. And Irma dies, and there's $2 million left. No Minnesota state estate taxes. She's fine. Now, what if Harvey died and the money, all $5 million, moved over to Irma? Well, guess what? Irma dies in 2020. Her state estate tax exemption is $3 million. $5 million minus $3 million is $2 million. $2 million is subject to Minnesota state estate taxes at 10% tax. She pays a tax of $200,000. So again, with proper tax planning, that can be avoided. The other major change was the domicile test. So when we're talking about domicile tests, we're talking about those individuals who are living part of the year in another state, say Florida, for example, a common state for Minnesota snowbirds to go, and part of the year they're living in Minnesota. In order to determine their residence, again, for state tax purposes, because Florida has no state income tax, Minnesota clearly does, there are a variety of tests that they use. One of the tests was the location of their attorney, accountant, and financial advisor. That is no longer, as part of this new bill, or the bill that was passed. You cannot look at the location of their attorney, accountant, or financial advisor to determine a resident's domicile. And so we're very happy, as financial advisors, we're very happy with that change. Moving on, so federal tax legislation. So let's talk about what has changed in 2017. And the truth of the matter is that not a whole heck of a lot, which is good for a change. So what's really changed? The big thing is that medical expense deductions. So for those who are 65 and older, the medical expense deduction was 7.5%. For those younger than 65, it's been 10% last year. Starting in 2017, it's 10% across the board. So it goes up for those 65 and older from 7.5% to 10%, that the floor of which you can deduct the medical expenses. Your medical expenses have to be greater than that floor to get some deduction. The other thing that they added is ABLE accounts, and ABLE accounts are similar to a IRA, individual retirement account, but they're for people for those who are disabled. So that's the other change for 2017. There are a few things that have been legislated out for 2017 as well, and we'll talk about that. So the first one is deduction for qualified higher education expenses. And what that means is, I don't mean to say that all education deductions and credits were phased out. That's not true at all. There are still a number of items that are available, but there was a specific deduction called the qualified higher education expense deduction. That is no longer for 2017. The other thing that is no longer is a credit for non-business energy property. So there was, again, 2016 and prior, there was a credit that was available for if you got solar panels on your roof, if you got insulation put in, you got new high efficiency windows that was reducing your energy usage, you could take a 10% credit. That is no longer available in 2017. Also no longer available is the deduction for mortgage insurance premiums. And finally, the discharge of qualified personal residence debt. And just kind of a quick reminder. So this is related to 2009, the financial crisis and the housing crisis, right? We had a major problem with homeowners that were underwater, get their home foreclosed on, right? The bank took over, they couldn't afford the mortgage. The bank took it over, sold the house, and they were relieved of their debt. The bank forgave them of their debt. Well, that's taxable income. Debt relief is taxable income. But clearly these families, they couldn't afford to pay for the mortgage, let alone pay for the tax on the debt relief. So Congress passed a bill or a law that allowed for those individuals in that specific circumstance, for those individuals who had debt relief, they were no longer obligated to pay a tax on that debt relief. Now that the financial crisis is really behind us and those housing issues are behind us, Congress has basically reinstated that debt relief based upon foreclosed homes, your personal residence, is now taxable income. Probably the biggest change is no change at all. And when I say that, what I mean is the biggest change is that there were a number of tax rules or tax policies that were in place that kept on phasing out every year that Congress was renewing. And that made it very difficult to plan in terms of what rules were in place, what rules were going to be phased out, and sometimes even Congress would reinstate the rules retroactive for the prior year. They would pass it in January of the following year for reinstating tax rules for that prior year. So what's staying the same? We're going to have 7 federal tax brackets in 2017. Capital gains tax rates are going to be the same for 2017. And again, when I say stay the same, it's not only 2017, it's stay the same on a go-forward basis until Congress changes tax law again, that is. Higher AMT exemptions that have been adjusted for inflation because it kept on going back to older numbers in that AMT exemption, that is now, again, permanent part of the tax code. And again, the PEP and PEAS deductions, that phase outs of personal and dependency exemptions based upon your income level, that is again permanently part of the tax code. Qualified charitable distributions from an IRA are also part of a tax code, permanently part of the tax code. And I want to stop for a second and just focus on this for a little bit about what is the qualified charitable distribution. So what this is, because it's a great tax planning opportunity. So what this is for those who are 70 and a half and over, you have to be over 70 and a half. It can't be just the year you turn 70 and a half. Those people are required to take out a distribution from their retirement accounts. And again, don't want to get into like certain nuances, but that's the basic rule. So their required minimum distribution or their RMD, they're required to take out from their retirement accounts, including their IRAs. What they can do is they can make a charitable contribution directly from their IRA to the charity. So it can't go to a donor advised fund. It needs to go directly to that charity. Can't go to them and then they pay the charity. It has to go directly from the IRA to the charity. And that donation can be used in lieu of their required minimum distribution. So that can make up their required minimum distribution. So what is the benefit of the qualified charitable distribution? The qualified charitable distribution does not need to appear as income on your tax return, and the deduction does not appear as well. So you would think, okay, well, I don't get the income, I don't get the deduction, taxable income, therefore, there isn't really a big difference whether I'm making a charitable deduction directly or whether I am doing this through the required minimum distribution. And by and large, that is mostly true, but not entirely true. And that is because certain phase outs of deductions or calculations of the tax don't give it kind of a one-to-one, that offset. In other words, $1 of income and $1 of charitable contribution does not create zero taxable income. And again, it is dependent upon your total adjusted gross income and your total situation. But in general, it would be better for both to be excluded from your return, both, in other words, the income and the charitable deduction, than for it to appear on your return. And certainly, for those people who are not itemizing their deduction, there is a huge benefit for the qualified charitable distribution. For those taxpayers who are taking the standard deduction and are not able to itemize their deduction, the qualified charitable distribution is a fantastic benefit because you weren't able to deduct the charitable contributions. Now, by using the qualified charitable distribution, you actually those taxpayers get a tax benefit of making charitable contributions, again, directly from their IRA, that they did not have available previously. So it's a huge benefit. The other thing that's really important about qualified charitable distributions that you need to know is that currently, and again, this is as of this presentation, but currently the 1099 does not have a box to denote whether the withdrawal from the IRA is a required minimum distribution to the owner of the IRA or a qualified charitable distribution. All of the withdrawal is going into the same box on the 1099. And this is really important for you to know because you need to inform your tax preparer the fact that you made a qualified charitable distribution out of your IRA. Otherwise, what they're going to do is they're going to put the entire amount of the qualified on your tax return, and then you're not going to get the benefit. It does not need to be 100% of the distribution. So if your distribution is $10,000, you can give $2,000 to charity, and $8,000 you can take out as your required minimum distribution. You still need to withdraw from the IRA the total required minimum distribution. That still needs to be withdrawn from the IRA, but a portion of that, or all of that for that matter, can be used to be given directly to charity. There is a total dollar limitation of up to $100,000 can be given to charity. You can give more, but only $100,000 will be part of your required minimum distribution. So if your required minimum distribution is, let's say, $120,000, then $100,000 can go to charity. $20,000 you still need to take out and needs to go to you. You still need to take out that $120,000. Just the split is different. And again, it needs to be a charity, a 501c3. It cannot be like a political organization or anything. Moving on. Low-income tax credits and deductions are staying the same. Child tax credits are the same for 2017. Deductions for classroom expenses paid by teachers for teachers buying school supplies or art supplies for the classroom, that is also a deductible expense. That's all the changes that are happening in 2017 or not really changing for 2017. Let's talk about, I guess, the elephant in the room, and that is the proposed federal tax changes. So the first thing I have to say is we have no idea what the final results is going to be. As far as I'm concerned, this was kind of more of a trial balloon and to start getting feedback. Generally speaking, I prefer to focus on what actually has been passed, and so that we can plan and not spend a lot of time on proposals that are out there that are probably going to look absolutely nothing like the end result. That being said, certainly because of the fact that it's been in the news, we should talk about it. And by the way, I do appreciate those organizations or individuals who do the work in analyzing those proposals and say what the impact is. And again, talking about the proposal, I'm really just trying to give, like Joe Webb, Dragnet, just the facts, give you just the facts of what we know, which is really not a whole heck of a lot, and not talk about it from a political lens, one way or the other. Again, purpose for me is really just to provide that information, education to you. So the first thing is that they talked about is reducing income tax brackets. And so they would reduce the brackets from 7 today to 3 today to simplify that. What income is falling under what tax bracket? We have no idea. The other thing that they talked about is that they would increase the standard deduction. So they talked about basically doubling the standard deduction. They would get rid of the exemption, and they would limit the use of itemized deductions. What the proposal currently is that mortgage interest would stay, charity would stay, state income taxes would go away. So that's the first proposal that's out there. Obviously, this is affecting different people. So those people living in high tax states are going to be affected significantly higher than those people who live in low income tax states, as well as, again, the change in the standard deduction and phase out of exemption that for low income earners would likely reduce their tax liability, although the amount of tax liability that would be reduced would be relatively modest. And when I talk about relatively modest, I'm talking about like anywhere from maybe, 3% to 15% change in their taxes. So not super significant. They have talked about repealing the federal estate tax and the alternative minimum tax. And again, totally getting rid of that. And then they have also talked about lowering the business tax rate. The last I heard was it was going to be closer to 20%. And that would also affect flow-through companies as well, like limited liability companies, that their income would not be taxed at their ordinary income tax rates. It would be taxed at a corporate tax rate. And finally, that they would do a one-time tax holiday for those companies who have income that was earned overseas to bring into the United States. Whether any of this gets passed or not, again, I have no idea. I believe, and again, I don't know this for a fact, I would believe that something will get passed. What exactly will get passed, I really have no idea. I would lean more towards the corporate side and not maybe many changes to the personal side. But again, that is a total guess. Have really no idea how that's going to happen. I also don't know. I have my doubts whether this will happen in 2017. Personally, I mean, obviously it's possible, but we are running out of time. But it very well could happen in 2018. Now, obviously, they could do it in 2018 and make it retroactive to 2017. And again, we would have, there's no way to plan for that. What I do think is important, though, from, again, the proposed federal tax changes, that I think we can be fairly confident is that tax rates are probably not going to be going up in 2017 for the federal taxes, and tax rates in 2018 are likely not to go up. And just knowing that is important to note. And also there's a possibility that there's, again, no guarantees, but there's a possibility that tax rates could go down in 2018. And that's important in terms of trying to tax plan for how much revenue do we, or how much income do we want to recognize in 2017 versus 2018. So let's talk about end of year tax strategies. And again, knowing where the tax rates are going to be each year, that's an important part of determining timing. Knowing your personal situation as well. When are you earning income? When are you required to take your distributions? What year, and how does that change your earned income? And basically charting that out. Or what other items do you have that could affect your earned income? Stock options, other deferred income, etc. And so it's really important to pay attention with your income by year, not just this year standalone. You really want to look at your income over multiple years and figure out what is the best thing to do in terms of either increasing or decreasing your income or expenses. And when I'm talking about increasing or decreasing income or expenses, we're talking about strategies that you could do that could change your income or your deductions to affect your taxable income, so that you don't get caught in a high tax bracket in one year and a low tax bracket in another year. You could shift your taxable income into different years to smooth out your tax return, your taxable income, and to reduce your overall taxes. And so that's where we say timing is everything. And so that could mean, let's say that they really are going to phase out state deductions. Well, so you may, if you are making estimated tax payments to the state for your January 2018 tax payment, you may want to make that payment in December. And because of the fact that it's going to be deductible in 2017 and may not be deductible in 2018. Looking at your tax situation, you may want to recognize gains in one year or losses in another year. Again, trying to figure out which tax bracket do you want to fall into in which year. Keep in mind that it's really important to factor in what your taxes are, both under the ordinary method as well as the alternative minimum tax method. You don't want to be in a situation where you're creating deductions one year, but actually those deductions are phased out because of the fact that you're in AMT. So doing that tax planning is critical. Big thing to remember for 2017 and every year is to take your RMD, your required minimum distribution. That needs to be completed by the calendar year of 2017. And if it is missed, there are taxes and penalties, etc. So that you don't want to have that happen. And again, a reminder that you could use qualified charitable distributions in lieu of your RMD. And we talked about that in depth previously. Also keep in mind, you can make IRA contributions or Roth IRA contributions. That is, there is income, it is income dependent. So again, you have to look at your specific situations. Those contributions, you have until April 15th of the following year to make those contributions. You also could convert IRAs to Roth IRAs. That would be taxable income to you, so that would increase your income. But could be worthwhile because of, again, what tax bracket you are in today versus what tax bracket you could be in the future. Or you could say, you know what, I think tax rates are going to be going down next year, so maybe it doesn't make sense to do this year, but could make sense to do next year. Just certain things to keep in mind. The nice thing about Roth conversions is even if you do a Roth conversion in 2017, you do get a free look back. So it could be worthwhile to do it in 2017, not knowing where tax rates are going to be. And if tax rates change, you can always recharacterize that conversion back to the IRA. You get a free look back. And you actually get, from the time that you file, that free look back is the later of when you file your tax returns, or sorry, the earlier of when you file your tax returns, or October 15th of the following year, which is the final date to file your tax return. Other end-of-year strategies is to keep in mind gifting. You may want to gift to individuals, and this would be more for estate tax purposes, and you can gift up to $14,000 per person per year without filing a gift tax return. Or gifting to charity. And gifting to charity, you could do that through a variety of different ways. You could do the qualified charitable distribution to charity. You could gift appreciated stock. And if you gift appreciated stock, you don't have to pay taxes on the appreciation of that stock, the unrealized gain. Or you could gift that appreciated stock either to a charity or to a donor-advised fund. And a donor-advised fund is kind of like a charitable bank account. So although it can be invested in anything, But the idea is that you are taking that tax deduction today, so you would want to take it when you're in a higher tax bracket, and then it is being gifted out to those charities in a future year when you're in a lower tax bracket. So the whole idea of the donor advised fund is for redistribution of your charitable contributions and reducing your taxable burden. So again, that is basically the major changes that have happened in 2017. What we see on the horizon, as well as a variety of different strategies that you can still do through the remainder of the year. We hope you enjoy this session, and as always, we are interested in hearing your feedback. Thank you very much.